Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and is managed by our company, LifeChamp. Our webinar title today is Decoding the Language of Financial Statements. So my name is Shin Chu. I'm the moderator for this session. Now, understanding financial statements is essential for investors to understand the prospect of the company. To be able to dissect the financial statement will mean that will obtain money-making information that can help us to make informed investment decisions. However, interpreting financial statements could come across as a complex thing to many investors because of the complexity of the jargons, and many of the ratios have not been making sense to many investors. So today, our speaker will do the best to dissect as many jargons to you as possible so that you'll be able to understand financial statements better. All right. So as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mention here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He is none other than Mr. Max Tan. Now, Max first indulged himself in the SME financing industry right after finishing his diploma in investment and finance in Har University College. He also served as a Rakuten Trade as a former risk and compliance officer, as well as the dealer representative with TA Securities. To date, Max has over 7 years of experience in the capital market as an investor himself, where he also runs One2Invest, a financial blog which amassed over 60,000 followers to date. Max is also the investment associate for private equity firm San Surya Capital in Berhad, and currently he is also a SGX Academy speaker. So it's a pleasure to have you here in this webinar, Max. How are you?
Hi, Shane, and good evening, everyone. I'm good. Hope you guys have a great holiday for the past 2 or 3 weeks, and also welcome back to work. But fortunately, market is open.
Oh yeah. So that's where we can find opportunities. All right. So I will stop sharing my screen and hand over the control to you, Max.
Right. Thank you so much, Shane, for the kind introduction. So let me share my screen real quick. Okay. Once again, good evening, everyone. Welcome to our session today, where the session is actually tailored more towards beginner and some who are very interested in the capital market but have no idea where do we start understanding companies, right? Because we have different kind of investors out there. Some we would like to study the fundamental parts aspects of the company, and some they would like to look at the historical price and also volume changes, which is technical analysis. Now, for today, we're going to look into the financial, which is the fundamentals aspect of publicly listed companies, so that you could understand them in a better manner, as Shane mentioned just now, so that you can make a better informed decision, right? Quick disclaimer, by all means, I'm not a licensed personnel to give you any advice. I'm a marketing rep. That means that I could help to promote certain investment banks products, but I'm not licensed to give you any investment advice. And by the end of this presentation, we are actually going to jump into a couple of case studies. You know, February, May, August, and also February, May, August, November is actually the busiest months for us, because a lot of company, they have their quarterly report out. Really, we spend a lot of time to look at the companies at all. So we will go through the how do we study the financial statement of company, and we will actually go into one or two, if time allows, then we go into one or two or three case studies in actual companies that their company just released their quarterly report. So if you have any company that is in your interest, you can comment in the comment section below. Later on, I'll go through and we will discuss the quarterly report of the companies, right? And brief profile about myself. Shane has already made the introduction, so I jump right into the topic for today. Right. For me, learning anything, I think, is very important that you have to make it fun and also interesting, right? If not, we are just back into secondary or maybe in your primary time where you, sorry for the teachers here, but there are some teachers that they're just blasting to you all this information. If you have the talent to absorb everything, fine, that's good. But for many of us, like me and myself, I cannot just sit there and I listen to the information and expect myself to really learn and also absorb whatever that has been thrown to us. So I think that holds true also for financial statements. So the number one thing probably we want to discuss today is making the financial numbers more lively. I'll give an actual case study that links back to our daily life so that when I look into a financial report, I can imagine what is actually going on behind the numbers. Right. So before that, I just want to have a quick check. Do you find studying financial statements of the companies overly complex? If yes, you are not alone. Me as well. Apart from some accounting background fans out there, I think they are dealing with numbers day and night, but I'm sure they are also fed up with looking at numbers all the time, right? And as Shane mentioned just now, there are a lot of financial jargons in the capital market, like ROE. People always talk about PE. Then suddenly you heard something like a enterprise value. Then you have DCF, discounted cash flow, to value a company. Then you have all this gearing ratio, and everything seems very complex. But when you tie back to a actual running business, it's actually not that complex, which we will try to do it on later on, right? And to be honest, now a lot of tools, online tools that allow you to actually go and check on the financial ratios of the company. Now you do not need to open the annual report of a company and then look into the annual report and manually calculate all the ratio yourself. Now, a lot of financial tools, they actually provide you the ratios that you need to assess a company. For example, ROE, ROA, and some onto gearing, profit margin. Don't worry about them if you are fresh to the market about the jargons. We'll talk about them in a bit later. Then we will also touch a bit about the valuation part, because a lot of times starting a company is actually pretty easy. Once you get into it, you understand the business, you are able to read into their financial statements. Then it is about how do you value the company to identify when to buy and sell. That's the most critical part in any investment, right? So yeah, let's jump into it. Okay. Now, don't think too much about the numbers. We're gonna take a step back. If we are going to approach the company that you are studying, it's just like your day-to-day business. For those who run their own business here, I'm sure you're not you are familiar with the numbers. But for those who are working normally, actually you come across different businesses every day. So take for example, coffee shop. If you don't drink coffee, then probably a tea shop, something like that. How does a coffee shop make money? Right? The first number one question. The basis of any companies that could go for listing is on the basis that the company has value, right? That's where you always see that the company always comment, oh, we're gonna bring shareholders value, this and that. But the question mark is, how does this company make money, right? How do they create value? So the number one thing we need to understand is their business. Which coffee shop, how do they make their money? Very easy. They're selling drinks. The margins for coffee is actually very good. I actually love the business. So when they sell you, let's take Starbucks for example, right? When they sell you a cup of coffee, how much does it cost? 15, 20? But the cost of them running, or the cost of the beans, the milk, probably costs less than $5 or so. So you can see that's how the coffee shop make money. But for good businesses, normally they have more than one way of making money, right? When you go to Starbucks, for example, or you go to any cafe, they will ask you, would you like food, or would you like anything else to add into your, apart from your coffee or apart from your drink? This is the additional revenue the company is generating. Okay, so we're going to start mentioning some financial jargons. The number one here is revenue, which is sales. Very straightforward. So sales equivalent to revenue. How much revenue you made is equivalent to how much sales that your company made. Like for the coffee illustration here, so how much revenue do you make from selling drinks? And from food, And if you go to some places, they actually offer you membership. Membership is actually a fantastic way to generate revenue and also cash flow, because you take the cash flow of your customer first, right? This resolve two issues. Number one, you have never have trade receivable issue because your customer pay you in advance. Number two, when you want to buy inventory, that means that your coffee bean, you want to buy your meals, you want to buy the food and everything, you have no issue, and you have a bargaining power to pay cash term to your supplier. So you get better margin over there, right? So imagine this, when you are signing up for buy now, pay later, normally there will be a fee charge, right? Why? Because you're leveraging on other people's capital. That is the same in the business operating world. When you are paying on a later term, normally there will be a slightly higher price. But if you pay cash term, you would have a advantage to negotiate for the price. For example, if I buy in, imagine this, if you go to any Pasar Malam, take for example, everyone is Malaysian here, I'm sure you all know Pasar Malam. So when you talk to the auntie or uncle over there, can I buy this shirt for 20 bucks? And normally you would haggle and negotiate about the price. But when you walk to the store and you say, I'm going to buy 100 pieces of your shirt, now give me 15 bucks, right? You see a discount or expected for the store owner to actually start thinking, if I can sell 15, yes, I earn lesser, but I can close my store now and I go home and have extra time to do other things, right? And for businesses, they have machine, they also have fixed costs to maintain, right? They take coffee shop as example, they have to pay their salary, electricity, and also some food. If they put there for too long, then it will spoil, right? But for their supplier, if I'm buying more coffee bean from you, right? So imagine that you are selling coffee bean to a coffee shop. So coffee bean, number one, it takes up your space, and when you're holding the inventory, effectively your money is not cash, right? Your cash is converted into coffee beans, right? So you might have cash flow problem. Then someone come to you and say, I'm gonna buy everything and I pay you cash. Can you give me a discount? Definitely yes. So any businesses that have the ability to take upfront cash flow is actually a fantastic kind of business. For example, membership, right? And other high margin source of revenue or higher margin kind of income is the merchandise, right? For example, if you go to Starbucks, normally if you walk into their store now, first thing you will see is their water bottle. Then probably bags, their tumbler, sorry, not water bottle, their tumblers, and also coffee bean, and also some drinks. Then subsequently over to their cabinet, then you can see probably they're selling some beans and more tumblers. That is because normally these kind of things, they generate even more higher margin product for them. But of course, the sales is not always as frequent as selling coffee, right? So it's where the concept here is to understand, actually every companies, they have a way of generating sales, and also there's a cost involved, right? So back to the coffee shop example, what are your costs? Number one is definitely my rental. Or if I own the place, of course, there's no rental. Number two is the headcount. I have to get staff to be the cashier, be the server, to clean the coffee shop. And also I might need a chef standby. And I also need some coffee expert, barista. These are the fixed overhead for the company. Whether you have customer or don't have customer, you still have to pay. Electricity is also probably another fixed cost for the company. So next thing you would have is the some variable cost. Now in accounting, there's fixed costs and also variable costs, right? Jargon starting to come in, but don't get confused. Very simple. Fixed cost is that my business, whether I generate any money, is still gonna charge me, right? For example, like your car installment. Whether you drive the car or not, the bank will still come to you every month, right on time. They will never miss. If they miss it, sorry, if you happen to miss, they will call you instead. So these are the costs that are fixed. No matter you generate revenue, yes or no, they will still charge to you. These are fixed costs. Variable cost is something that is normally more related to your revenue generation. For example, as I get more income from selling coffees, so what am I consuming more? Number one is probably, yes, coffee beans. Number two, milk. Number three, and maybe sugar, syrup. Probably utilities would increase because I use my machine more. And maybe you need to pay your staff OT. That is also a variable cost. So there's always two cost element in a business. Then when you have your revenue, your sales, deduct by the cost that involved in the business, you will get a profit. The profit is effectively what makes a company has value. Nobody, unless you are investing in startups in US market, that's a completely different ballgame. But those companies, they also come with an expectation that they will earn money, which is in fancier term profitable in future, right? What makes a company has value is the ability to make money. That means that to have profit. So when you study any businesses, make sure that their sales is able to cover their expenses of the company, right? So that's the most fundamental part of understanding a business. Revenue minus the cost of sales is equivalent to the profit. Okay, then when you go into any financial report or statement, there's always three key pillars. Number one is the income, which I roughly mentioned just now. And number two is the balance sheet. Now, balance sheet is actually also very, very important for investors to understand. Why? Because imagine this company, they are having very, very good sales, right? But at what cost? Maybe they borrow money from the bank in order to have marketing activities so that they put ads on Facebook that could target you maybe on Instagram, and maybe they put their advertisement on newspaper, maybe they put it on TV, maybe on the billboards and everything. So you need to understand whether the company are they having a lot of debts to run their business, or is it a debt-free company? They are asset rich. So let me give you an example back to the coffee shop just now. So what are the assets? That means that asset is when you buy a car, the car is your asset. And the loan of you owing the bank, unless you cash buy, then it's a different story. The loan that you owe to the bank is your liability. Liability in Robert Kiyosaki terms is something that take out from your pocket for you to understand better. And for asset is basically something that you own for simplicity's sake, right? Your phone is something that you own, but if you buy it with your credit card, buy now, pay later, then the buy now, pay later sum is your liability that you have to pay back the bank every month, right? Or the platform like Shopee. So when we go into the company, we need to understand what kind of assets they have, right? Number one, coffee shop. Probably they own a shop, then they have a property and they have the machineries, then they will also have furnitures, and they will also have the inventory, right? Inventory, that means that their tumbler, their coffee bean, and their milk or whatsoever. And then move on, you would have the cash that they have, right? Every businesses, they need a certain level of cash to run their day-to-day operation. You never know when you would not get paid. So reserve a certain level of cash is very important in whatever businesses, right? That is for the asset example. Then moving on to liability, something that you owe someone. For example, if I purchase the property, right, and I owe the money to the bank, then I would have borrowing. Then subsequently, if I have I'm buying the coffee bean with a business term, that means that I take your beans now, I operate, but I pay you 90 days later. That's quite normal in Malaysia, 30 to 90 days payment term. Whether it's someone paying you or you paying someone, it's very normal to have a trade payment term, right? So that would be your liability because it's something that you still owe someone, right? Subsequently, you would also have something called lease liability. It's a bit complex, but you can understand that that is something that you sign a lease agreement, so you rent the shop. The renter is actually factored into lease liability, right? For example, then these two elements, but when you have asset, then you minus off your liability, you're left with equity. Equity, that means that or other term is net asset that you own in a company, right? For simplicity's sake. Then one of the neglected or one of the most important statement that I would like to highlight is the cash flow statement. We mentioned about a coffee shop, you have a lot of ways of generating revenue. You sell coffee, you sell food, and you have the merchandise. But what if every customer that walk in and they would tell you that I'll pay you 3 days later, I'll pay you 6 days later. So what happened to your cash flow? You pay the money upfront to someone else, and then subsequently when you do business, you don't receive the cash first. So what do? Now, when you put yourself in such a scenario, it seems like absurd. Imagine if you're working, right? You have car loans to pay, and you have your mortgage to pay. But suddenly your boss come and tell you that, sorry, I'm gonna delay your salary payment by 3 months. So what happens to you if you don't have a cash flow? Probably you jump, you probably report, and you probably leave the job. But for businesses, they have no choice. If their customer really tell them, okay, see, I'm having difficulties, I can only pay you 3 months after. So whether you take it or you leave it, right? So in the real world of business, there is no right or wrong per se. So when you invest in the business itself, make sure that the company really have cash into their businesses, right? This is where we can observe that in the cash flow statement. So don't worry, a bit abstract at the current moment, but later on we'll actually go into some companies to look into their financial report and actually discuss each of this statement together, right? I think it will be easier to understand that way later on. Okay, so key elements of each pillar. As I mentioned just now, so revenue minus cost equivalent to your profit. This one is relatively easier to understand, right? But also one aspect that I want to highlight, that's something that the numbers could not show. Now, in Malaysia, the quarterly report, when they were announced, normally is delayed by 2 months. That means that February is a very busy month. You always see quarter report has been announced, right? But as a matter of fact, normally they are the financial result for 2023, October, November, and December. So what does this mean? That means that the business, they have already passed for 3 months, which is October, November, December, then wait for another 2 months to show you their financial result. So what would happen within this 5 months period, right? The share price could go up and down, and their result, when they come out, is already past tense. Some things might not be applicable. I'll give you an example. So let's say there's a certain subsidy for buying cars in 2023, right? Everyone would rush to buy their car before the subsidy ends. So what will happen to the sales of this car manufacturer or the car dealers? Their sales will increase for that past quarter, right? Definitely. But what happens when move into Q1 2024, which means that the next year, January, February, and also March, you will see that the revenue generated for the next period, which means the forward period, you could not expect what could happen if you are only looking on the past. So you need to understand, again, how does this company actually make money? What are you doing that could generate you revenue? In Malaysia, we are pampered with over 900 to close to 1,000 companies, and we have around 10% of them are in the property market. That means that property developer. Normally, residential property developer, big names like Marsing, Ecover, and we also have Radium, which is closely related to PV. So all these big names that you can see. So how does a property developer earn money or generate sales or revenue? By selling property. Very straightforward. So what are their costs? Construction costs, marketing costs, and maybe land purchase costs. So these are the costs involved. When you're looking into any company, apart from looking into their financial statement, after looking at the financial statement, you need to understand how are these numbers being generated. For example, the revenue is 1 billion. How? What are they doing to have a 1 billion revenue, right? If they have a profit of 100 million, how? How are they generating 100 million profit when they have a certain amount of revenue? What do they do? How do they control their costs? These are the things that you need to consider when you're studying into a financial statement, right? But don't worry, this is something that you will progressively train your mind to actually learn about that, right? The more you understand the industry, the more you are able to find out the future revenue, future cost involved for the company. Very straightforward. I'll give you another example. So let's say a company is selling palm oil, CPO. right? When CPO prices go up, normally what will happen to the company upcoming financial performance? Normally it will be better because CPO prices went up, right? So you could roughly predict how much the company would earn. That's what people call in deeper sense is financial modeling. But if you don't have the capability to do financial modeling, don't worry. You can have a rough sense of how does the company actually earn money, right? Then having assets, liability, and also equity, understanding them is also very important. In Malaysia, there are some cases that they are very asset rich, but for my personal opinion, asset rich doesn't mean that when you buy the company, you could earn a lot from it, right? When I buy any listed company shares or when you invest in any listed company, remember we are investing as a minority shareholder, right? Who decide on the direction of the company? Number one, the C-level, the management of the company, and the major shareholder, right? The major shareholder definitely have a say on the direction of the company. Now, when you look into some company that is asset rich, so let's say this company have a lot of land banks, their net tangible asset (NTA) probably is, let's say, 500, but the share price is only trading at 1 ringgit. So you would say, wow, hugely undervalued for this company. So you would think that whenever this company sell their land bank or to utilize their land bank, you will earn a substantial sum. But my question is, when are they going to sell? You will never know because you are not the management of the company, right? So asset rich, understanding how much asset they have is good because you know that how much this company is worth based on asset alone, right? If anything happens to the company bankrupt per se, then you will get back this amount of money. But normally, I will tell you that before they go bankrupt, definitely they burn off all the asset. They'll sell their land bank, sell their machinery to in order to get cash to pay off their liabilities. So to me, NTA is just a reference. The asset of the company is just a reference, but not something really a huge indicator I will rely on when choosing any company. But there's one important part that asset can give you an indication is the ROE or ROA, return on equity or return on asset. Is basically a metric to calculate how efficient the company is utilizing their assets or utilizing their net asset equity to generate revenue or to generate income. For example, I give you two companies now. One company, they have a lot of land bank, but they only generate okay, never mind, maybe not property company. So let's back to the coffee shop. Okay, so let's say this coffee shop owner, they have a very modest shop over there. Then they generate revenue of probably 1 million per month, and they have an asset worth of maybe 3 million, right? Another company, another coffee shop, they have a light business model, right? Maybe their asset, they only have 500,000, but they are able to generate the same amount of revenue as the company before that has 3 million. So you might want to start thinking, why is this company with so little asset, they are able to generate revenue so efficiently? There must be something that this company has done right to generate so much revenue, right? Maybe their shop is smaller, their staff is more efficient, their coffee is priced higher, or their margin is simply better, or their cross-selling is very effective, or their pricing strategy is so good that people go in, I'll buy 5 coffees because when I buy 3, I get 2 for free. But yet I could generate a huge sum of revenue. So there must be something interesting that this company does, that the return that they generate on the asset or the equity is better than the competitor, right? So there's one metric that I would measure on the company. When another thing is the liability part. Normally, I would avoid overly geared company. So overly geared means that the company take up too much debt. It's very similar to any each of us. So for example, if you are working and you're getting a salary of 5,000, for your car installment, maybe you're paying 1,500. Then for your home installment, let's say you're paying another 1,500. So every month, your take-home pay is, let's say, 5,000. You already lose out 3,000 that you must pay to the bank. So you left with 2,000. When you look into companies, let's say they generate a revenue of, let's say, 100 million, but every month or every quarter, they have to pay off, let's say, 70 to 80 million to pay back the loan of the banks, right? Whether it's interest plus capital or interest only cost them, let's say 10 million per quarter. So it's quite hefty and quite heavy for the company. So normally I will look out for company that is not overly high in terms of gearing. We talk about gearing later on, right? So I mentioned just now, cash is actually king in whatever business that you run. So what is effectively the best business that you could do is you just lend out money and then you just collect interest, right? But unfortunately, it's not so simple. That's why banking system exists, and cash flow is still very important for any businesses. Any businesses without cash flow, I can tell you that they wouldn't survive. No matter whether you're running a coffee shop, imagine your customer pay you 3 days, 6 days later, or when you're running a manufacturing company, your client say that I pay you 60 days later, and your supplier come and chase you. If you don't pay me now, I'm not going to supply you next batch of raw material. Then when you tell your client that you couldn't produce the next batch for them, imagine that they tell you, I'm not going to pay you until I get the next full batch. So what happened to your business? Effectively, you're stuck in the middle and your business couldn't run anymore. So taking another example, property development, right? A lot of cost has actually involved in the property development sector. If the company does not have enough cash or financing, it's very tough for them. So number one, you have to buy the land bank. Number two, when you buy any house, right? When you borrow a sum, let's say you buy a house, 300,000, the bank does not immediately release the money to the property developer. There's something called HDA, right? That holds up the money. So let's say if I build up to a certain stage, let's say I finish up to 10th floor, then the bank will pay me a certain percentage. I finish up to 20th floor, then the bank will continue to pay me another sum. So imagine that if I am stuck, I couldn't pay my construction partner, right? They wouldn't work without without money, definitely. And at the same time, the bank say you have not completed to certain stage, so I would not release the sum to you. So what happened to a project? Then the project will get stuck. This is why we have a lot of abandoned project in the market prior to the HDA case. So some developer, they take the money because there's no retention, right? I don't hold on to it. Whenever SPSI, then I take the money and I can sell away. But now, no. You have to go up to a certain level and the bank will release the money to you, right? So imagine if you are stuck in the middle. For example, you get the next batch of money at 20 floor, completion of 20 floor, but you're only at 15 now. Then your construction team come to you. If you're not paying us, then we are not going to help you to continue building this property. So what happens to you? You get stuck. So in any businesses, always look into their cash. As to how to look into it, I'll talk about it later on. But generally speaking, there's three cash flow statement that you can view. Number one is operating cash flow. How much money did I generate from running my businesses? Number two is investing cash flow. Anything related to investment will be put into this column. And number three is financing. Let's say I borrow bank loan, I'm going through IPO and things like that. It will go into the financing cash flow, whether it's cash in or cash out, right? Interestingly, when you borrow money from the bank, your liability would increase, your cash would increase, and it will show a positive number in your financing cash flow as well, right? So these are the three main pillars that you will see in any financial statement. Okay, maybe you quickly go through some of these ratios before we go into the actual examples. Number one, return on equity, return on asset, we briefly mentioned just now, is a measurement on how effective your business is running. Generally speaking, return on equity, return on asset, the higher the better. That means that with lesser asset, you're able to do more. It's same like our day-to-day life. People who can deliver more with lesser resources, they are deemed as better. So let's say if I give you 100,000 to get a project done, and I pay someone 50,000 to get the similar project done at the same quality, so definitely the 50,000 one would win. So it's the same in the business world, right? Then current ratio is something that you measure the liquidity of a company, right? Current ratio is taking the current asset and also current liability. So we're moving back into jargons a bit now. So what does current mean? Basically, it means that it's less than 12 months. So when I have a current asset of, let's say, inventory, that means that I would expect my inventory to be utilized within the next 12 months, right? If I have a current liability, then of a banking loan, for example, I would expect I need to pay this sum within the 12 months, right? And non-current is something more than 12 months normally, like your property. You don't expect to sell off your non-current asset, which is property, within the next 12 months, right? If you do, then you plan, probably the accountant will adjust back into in ready to sell asset, something like that, right? And quick ratio is also a liquidity indicator, which we discuss a bit later on. Then debt to equity ratio is something very important. It's very similar to gearing. It's a measurement to how effective actually your how much debt your company is actually taking as compared to the net asset level, right? This is very important as we don't want to invest in companies that have so much debt. Okay. I missed out this part just now, but when any company have a lot of debt, right? What happens when the interest rate increase? Immediately your commitment increase. So very simple example. When I give you your house loan as the example, what happens when OPI increases? Probably within 5 days, banks are very effective. Within the 5 days or 10 days, working days, then you'll receive an email or SMS or a physical mail to your doorstep that inform you that your installment amount will increase from this amount to that amount due to OPI increases, right? So imagine in a business, if I have a loan of 10 million, right? I have to serve the 10 million loan interest on monthly or quarterly basis. Normally it's monthly basis. So I have to continuously serve the interest. When interest rate jump significantly, like in the US market, as for example, so the cost of running the business will increase significantly. So don't forget, these factors, they actually link together very closely. When your interest expenses increases, so what happens to your profit? It becomes lesser. When your profit becomes lesser, the cash flow you get also become lesser. Then when you have lesser cash, there are lesser things that you can do, right? Impossible on high interest rate environment, you still go out and borrow more money in order to get cash to do more things. That's very risky, right? We rarely see such cases unless the company is really desperate for cash. So it actually everything interlinks when it comes to running business and also the financial ratios, right? And we also have the most common valuation indicator here, which is the PE ratio. So PE ratio is very straightforward, the price to earnings ratio to value a company. Let's say the company is earning 1 ringgit and the current share price is 5 ringgit. So the PE ratio of the company is 5 times, right? Normally, the lower the PE, the better it is. But sometimes there are also traps that could affect the PE. Number one is that for the earnings of the company, let's say this company, coffee shop, suddenly they going to sell off their shop. Okay, they're probably moving to somewhere else, but from owning the asset, they're going into leasing. That means that they're going to rent the property now. They're going to lease the property and to run business there. Then they're selling off their old property. When they sell off the property, they might have a profit. So that profit will also put into your profit and loss statement. That is when your earnings increase and your PE decreases. So you look at the company, wow, the company is so cheap now. The PE decreased drastically. So when you look into PE, very careful whether there's any one-off factor that contributed to the low PE, right? Normally, there's one-off cases that contributed to low single-digit PE, or there are some underlying funny things that are going on with the company. There is actually a case back in, I think 2-3 years ago. I cannot name the company, but the company is constantly trading at 2 to 3 times PE. Maybe 3 or 4 years back then. The PE is very low, 2 times, 3 times, right? That means that for the company is running, they're earning 100 million. The market cap is maybe only 200, 300 million. So very cheap. Even if you buy private businesses, it couldn't be that cheap because the company still have assets this is only the earnings potential, right? I give you this idea. Let's say if you buy a private business, the company generates 1 million in profit every year after tax. You buy the company for 5 million. So without adjusting for inflation, within 5 years, you will recoup your investment, right? Every year, 1 million, 1 million, 1 million, 1 million for 5 years. Then for the 6th year, that would be your net profit, right? That means that the 1 million is my pure profit coming from the business I buy. So the cases in this company is constantly trading at 2 or 3 times, which is ridiculous. No matter what market that you put it in, it's not one-off. The company constantly delivering very nice profit numbers, but there's one critical element is that the company doesn't have a good cash flow, right? That means that there could be a potential accounting fraud involved in that case, right? Because they are putting up very nice numbers that unfortunately it could be done by generating invoices, but that one is a bit complex. That the case. This company, I think some might think this is a oil and gas company, but no, this company is actually a IT company, right? So the company itself, if you look into any company, they are having good financial numbers, but for a prolonged period, if they do not generate cash flow, which is represented in their operating cash flow, so you might need to be a bit careful on the company that you are looking into, right? Because 1 year of the financial account closed for 365 days, right? So imagine if you're running a business, you sell the product today and you couldn't get the cash back in a year time. So how bad would it be? Just imagine that if you are working normally and your boss come and tell you that, okay, I'll pay your salary a year later. So how do you sustain in the meantime, right? You have car loan, you need to eat, right? You have utility bills to pay. You have your phone bill and everything. So that is the same in businesses. If it's not generating cash flow, so be careful on it, right? Okay, now we'll move into some actual case studies later on. Okay, let's see. Do you guys have any interesting companies that you would like to discuss about? Maybe we have a bit of time. If you have any company names that you would like to discuss about that I have the capability to talk about the company, then I would explain their business model. But if I don't, probably I just go through their quarterly report, right? Okay, we have our friends here, MMSV, TRC, Capital Air, VS, Armada, YTL Power Time. Okay, I do my best. I do my best for everyone. So let's go for, to be fair, whoever comment first, I'll go through a company, TRC, right? So give me a minute. Let me share my screen. Okay, I think TRC just released their report recently. Okay. Okay, this is something quite important that I would like to share. Okay. By the way, the platform, if you're new to capital market, this platform is actually called Currency Screener. It's quite helpful. But if you want official data, of course, you can go to Bursa announcement, right? So when you look into the announcement of a company on their quarterly report, there are some times that they will split it into 2 parts. Number one, which is this part. Okay, sorry, my line a bit slow. Probably need to complain to Time later on, which is another listed company. Okay, so as you can see here, this is actually the actual financial statement. But on this part, it's all numbers, right? There are some company that does this. Number one, they would have the numbers, and number two, which is the most critical part that a lot of people don't actually look into it, which is the explanatory notes. That means that I will explain to you what happens in this quarter particularly. For example, here the company pay dividend, and you can see here for the revenue generated by the company, where does, again, back to what we have learned earlier, how does the company make money, or how do they generate sales? For TRC, it's from their construction, it's from their property, it's also from their hotel operation. So you see that a lot of companies, they actually have businesses that are in synergy, right? If I'm expert in construction, so why not I also build my own property? Then when you have certain level of property, a lot of property companies, you will see that they have their own property investment division. Maybe next to their property, they will start building hotels or whatever things like that to generate a more recurring stream of income. Because for construction, for property, right, they are one-off in nature. In studying any businesses, you have to understand that the business is either recurring or is one-off, right? For construction, it's very straightforward. Let's say if I'm building a new project, whenever the project ends, then the revenue coming from this project ends as well. This is non-recurring in nature. But what if I'm Maxis, right? And you sign on to my postpaid package, that is recurring in the nature. That means that whatever happens, I sign a contract with you for 2 years or maybe 1 year, you have to pay me the fees every month. That is recurring in nature. So from speaking from personal experience and my observation on Bursa, companies with recurring income in nature, they would have a normal valuation. Why? If I ask you this, let's say if you are buying into businesses where it's not listed, right? It's a private company. The company tells you that this year we might earn 3 million, next year we might earn 1 million. And another company come to you. It says this year we might earn 2 million. Subsequent year maybe 2.1, 2.2. We have a very stable stream of income. Which company would you prefer more? For a lot of people, it's always the predictability of the earnings of the company, right? So normally this kind of company, they would yield a higher kind of valuation. Okay. So back to the quarter report. Okay. Now that we understand, actually this is first time going into TRC quarter report, but let's go through it together. When we look into the financial statement of a company, don't get scared off like, wow, this is so complex, so many numbers. So we look at it one by one. Let's see if I can highlight. Okay, never mind, ignore it. Okay, so let's say revenue. Revenue is very straightforward from what you see just now. Okay, over here, this is the revenue. Okay, this is the revenue, how the company generate the income. I'm not going to repeat this part. And cost of sales. So what is the cost of sales of construction company? Labor, raw material, financing costs, and mainly is raw material and labor for construction companies. Then for their property development, is the construction cost. And for property hotel management is the utilities, and also some licensing fee, and also your labor. Labor is quite intensive, and also the disposable items like some towers, so like the toothbrush and everything, those are your cost of sales, right? How do you generate the sales? What are your costs involved? Then you arrive at a gross profit. Gross profit is in layman term, it means that after revenue deduct by cost, then I would arrive at the gross profit of the company, right? And this is before deducting other non-direct involvement in the businesses. For example, I have if I'm manufacturing iPhone, so what is my direct cost? Is the raw material and also labor, maybe utilities involved in the business. But if I have a manager that is helping to do the sales of the iPhone, so is that under direct cost of manufacturing the iPhone? No. So that will categorize in under other kind of segment. So normally they'll put it under admin expenses. Then they also have logistics, distribution expenses. So sometimes you will see more complex terms in the financial report, right? For example, here, if the company is dealing with foreign exchange, for example, a lot of furniture companies in Malaysia or export-oriented company, then you will normally see that they would list out that, oh, this quarter I have how much of unrealized or realized foreign exchange gains, right? So over here as well. Then this one is a bit complex. This one is a bit complex. Basically, it would means that for the benefit of understanding, if you see this in the future, okay, it's a bit long, but you can read it part by part. So number one, expected credit loss on trade and other receivables. I use another example so that it's not so offensive in nature. So let's say you're a coffee shop, then a very close friend come to you and say, hey, can I have lunch here? I didn't bring my wallet. Can I pay you next week? And I'll come back here and pay you. So you provide the lunch. That means that your cost has already incurred, and the client is your trade receivable. Subsequently, the guy finished the meal and walks out. And after a week, you try to call the guy, never pick up, never everything, and you couldn't contact him again. So that would, and when you do your accounting, a month later, so you expect this guy, I expect he's not going to pay me back. So there's an expected credit loss on your trade receivable, right? Then allowance is that I roughly expect how much of loss that I will incur. That means that it's not fixed, confirmed yet that he will not pay me back, but I will make an allowance first. Then moving into deeper, another more complex layer, reversal. That means that the expectation changed. He called me back and he say, next week I might pay you, right? So there's a reversal of allowance for expected credit loss. It's a very long name. I'm not gonna read it all, but yeah, it's a lot of funny and interesting elements in the financial report. So for the benefit of time, I'm not going to go through one by one, but if you happen to come across something that you don't know, what do you do? Very simple. Get a chat GPT and ask the chat GPT, prompt it to ask the chat GPT to explain in layman terms. So whatever these long names, I'm sure ChatGPT is more than sufficient to answer you with layman examples. So as you progress, as you read more quarter report, very quickly you will understand all these financial terms, whether there's any funny things that are involved in the quarterly report. Like for TRC, I think it's quite standard. Some companies, some funny companies, you will see that their revenue, they will make a gross loss over here, but you see that they have a high other income. Then suddenly their profit after tax become positive number over here, right? So as you study more quarterly report, you understand more whether the finance makes sense to you or not, right? For example, in last quarter, the company making 10 million. Suddenly this quarter, 100 million. So there must be something happen, right? So you wouldn't buy into the company blindly before studying what is actually going on onto the company, right? That is for the statement of comprehensive income, some call it profit or loss, but it basically gives you a holistic view of how does the company perform over here. So over here, actually TRC, they have a drop in terms of their profit. That means that the net revenue minus their expenses, the net income that they get from their operations is actually reduced. Over here, you can see from 30.4 million to 7.1 million. So probably we look into the notes for the company, what actually happened to the company, right? That's very important. So let me go to the quarterly report here, and we will go back into the balance sheet. Okay, so over here, okay, let me see whether they have a comparison. Okay, usually the company, they will provide a comparison note. Yep, over here. So they would explain what is actually going on for the quarter. Let's see here. The company had PBT, profit before tax, of 10 million compared to 47 million before, right? You have seen over here, the company basically explained that in the past year, that means that we are looking into financial year 2023 Q4. That means that October, November, December for 2023. Then comparison with the corresponding quarter in last year, okay, fancy name for last year, looking into 2022's October, November, and December. So it's comparing quarter to quarter. This is very important to see whether the company every year are you improving. There's also another metric that compares on quarterly basis. Every quarter, are you improving? Rarely you will see companies that could sustain a continuous quarter-on-quarter growth. It happens back in 2021, 2022 for tech companies, but it's really rare to identify such companies because you have seasonal factors. For example, Chinese New Year, your days of operation is lower, so naturally your revenue generated will also be lower in that sense. So it might go up and down. The seasonality factor. For example, CPO, price goes up, my result are better. Price go down, my result probably slower. So rarely you will see quarter-on-quarter continuous growth companies, right? So basically, over here you can see that the company say, oh, last quarter we have a ending of a particular project, and also one important term here. Let me highlight it for you. Something that you should take note. Sorry, sloppy hand. There's a revision of budget costs. So, okay, this is something that is non-direct operational. That means that there's an adjustment in simpler terms, it's more towards a paper kind of adjustment, right? So this is very important. When the company have some paper adjustment, normally it wouldn't reflect into their cash flow. For example, for the allowance for trade receivable, sorry, let me drink a bit of water. Okay, sorry. For example, let's say depreciation, right? If you buy a property or buy a machinery, by right, my cost involved is let's say if I buy a laptop, simpler. If I buy a laptop, immediately I pay, let's say 5,000, 3,000. I pay it off and I receive the laptop. But when I put into account, then it's something different. There is something called useful life for the assets. So let's say the accountant decided that this laptop is going to last you for 5 years. So every year, it will lose 20% of the value of this laptop. Excluding the scrap value, that one is a bit complex, but there's a depreciation. But the cost or the cash involved, actually you pay off in the first year, right? Subsequent third, second, third, fourth, or fifth year, you don't actually pay out any cash flow anymore because you paid it upfront. So the depreciation is actually non-cash in nature, right? When you look into the financials of the company, make sure again, everything is linked back together. Look into their cash flow as well. Okay, look into their cash flow as well. So on some cases, as you see here, right? Okay, allowance for ECL. Okay, allowance is something that I expect I couldn't take it back. For looking back into the example I have just now, my friend come to my restaurant, makan, and he left. Then I expect he won't pay me back, so I have allowance or ECL. So this is something that I should put into my profit and loss, that I expect this amount of sum is total loss, right? I couldn't receive it back. My trade receivable ran away. It's an allowance, but doesn't mean that it should expense my cash flow. It doesn't expense my cash flow at the moment because I didn't lose the cash, right? I didn't actually lose the cash. There might be a potential of such cases reverse, which is the reversal case that you see here, right? So understand that there are some cases that you have cash in nature and also non-cash in nature for your profit and loss statement, okay? Then looking into the balance sheet, okay? I need to go into another example, so probably I go a bit faster. So as I explained just now, you have current and non-current asset. Current asset, very simple. 12, within less than 12 months that you can dispose it, for example, inventory. Now, contract cost is actually a bit complex. It's normally a common term that you see in construction companies. That means that I have incurred my costs for construction, but I haven't went for claim from the developer, right? It's an asset to me that I already incur money to build this property, but I haven't actually go to claim, or it haven't reached the 20th floor that I mentioned just now. Maybe it's 15 now, but I incur the cost already. So I'll put in an asset for now first, for layman understanding. Then you have your trade and other receivable. Whenever that when you made a sale, but the person haven't paid you yet, right? It says that it will pay you within 6 months, then it's considered your asset because this is something that you could receive the money from in the future. Okay. Then you have deposit, cash, and also bank balances. Very straightforward. That's your cash. Then you have property. So you might wondering why you have inventory here that is non-current and you have inventory here that is current asset. Okay. For this company, is construction and also property development. Sometimes they would categorize the property they have as inventory that they expect to sell in 12 months. Some they might expect not to sell in 12 months, or maybe it's land bank, right? But the company has construction in it. So there might be raw material like the steel bar, like cement and everything that could put into their inventory. So it depends on the nature of the company itself. Okay. Now, okay, RU, right of use, is basically that, like the renter. Normally, this is actually something introduced back in 2018 and 2019, MFRS, Malaysia Financial Reporting Standard 16. Last time, if I remember correctly, for your renter, you don't actually have to put into your balance sheet, right? Someone mentioned capital A just now. The introduction of MFRS 16 actually have a huge impact into the balance sheet and also profit and loss statement for capital A at the time. So right of use asset, because you have liability, lease liability over here. Okay. Let me see. Okay, contract liabilities maybe. Okay. So let's say if I rent a certain equipment, I have the right to use that equipment for that period. But how do I quantify it? So I would normally tie it back closely back to the rental amount to justify the value this asset brings me. So RU, simpler explanation is the value it brings me, or the tenancy value that I rent a shop. Let's say Padini, a lot of RU, because they rent a lot of shop to run their businesses, retail businesses, right? Equity part is a bit complex. Honestly, I think this is not something for beginner to really dig into it too deep. But look into the retained earnings of a company, whether the company has made a lot of profit previously. If a company has a close to, if I remember correctly, if a company has less than 50 million in retained earnings or, shareholder equity, if a company has very low retained earnings, be careful. If they have another 1 or 2 quarter losses where they have a negative retained earning or retained losses, then the company might fall into PN17. The share price will also fall drastically. Okay, on those cases. Okay. Okay, this is the cash flow, operating activities. So the changes in cash flow, 3 parts. Number 1 is how much cash they generate from running their businesses. Okay, this is the final figure. You can see that this number actually have a big difference with their profit before tax. Now, normally I would have a measurement whether the company, let's say, earn 100 million in profit. So I would expect the company recovers at least 70 or 60% of the cash. But in this case, the company earned 32 million this year, but the cash inflow is 200 over million. Why? This is because that their contract asset liability decreased. That means that they are able to claim. They incur costs in this, so that's why this increases. But their receivables pay them back over 200 million, 250, close to 250. So that's why you see a huge increase in cash inflow over here. Then over here is the investing activity. This is what we normally, if you see analysts, they always talk about capex or pex. This is normally into the capex, capital expenditure. When you buy laptop, you buy machinery, and for some companies, if I'm a manufacturing company and I'm buying a property, then that one is my capex. But if I'm a property company, I'm buying another property, it might be my inventory, then categorized under operating cash flow. So again, it ties back to whatever businesses that you're running. Okay. In this case, so capex over here, how much they use when they're purchasing property, how much they get from disposing property, ROU as well, how much they get from disposing the ROU, maybe terminate the ROU, and then they have other items as well, like the profit from a JV. JV is also a bit complex. It's basically me and you, in friendly term, we open a company, JV. We work on the company together. It's quite common for property and also construction company to have JV. Then financing cash flow, this is also very important. After you observe the cash generated from operating activities, go into financing. See whether the cash they generated in business, is it sufficient to cover payment or cash outflow from financing activities. Okay. In this case over here, you see that they have a repayment of short-term borrowing. That means that it's something that will incur for the next 12 months, 60 million. So 200 million is definitely more than enough to cover the 60 million, right? And net, they actually use 72 million in financing activities. So yeah, it's more than enough to cover. So the company, sorry, I couldn't actually see. But if you look over here, they actually have quite a hefty amount of cash in their bank, right? But again, you have to compare back to their borrowings. Their borrowings, non-current 95, current is 6. So for construction and property company, by comparison, the ratio is actually relatively healthy. Okay, so let me go into probably a quick company, another company, then we move into the Q&A part. Okay, let's see. Okay. Okay, capital A is a bit too complex, unfortunately. Let me see VS has their result. It's a bit outdated, but yeah, I guess we can look into it. Okay. So for those who don't know, VS Industry is actually a very famous EMS company in Malaysia. Basically, Dyson is probably, I don't know, I do not have firm answer. Probably they are one of their significant client for VS Industry, right? So how does this company generate revenue? It's basically my client, they will have supplier and then they send the parts to me and I will assemble it at my facility. Okay, maybe I will manufacture some parts, for example, plastic injection molding. I will do the outer layer of that product and then I will assemble it. Some more advanced company, they will also do some chip. They will do some mainly assemble, I would say. Okay, and to some they will do some plastic injection molding, like the casing, the external casing. Some they would involve in design with their customer, right? So by categorization, this is effectively a technology slash manufacturing company in Malaysia. So their revenue is generated by how many units of the product, for example, vacuum or hair dryer that they produce. How many product they produce is their revenue. Then the cost of sales, right? They are raw material. EMS is a very labor intensive industry, so it will require a lot of labor. So their costs probably involve a lot of labor as well. Then you arrive at the profit and profit before tax. And also this is the from operating activities alone, how much they generated, right? Then moving into their cash flow. Okay, so you see over here, because of the increase in trade and other receivable, this is actually quite normal for business world. So when you're running a business in the actual world, don't expect that the customer say 3 months I'll pay you in time, right? Maybe your customer's customer delaying payment to them as well, right? So in turn, they will delay their payment to you. But there are also occasion that they drag you because when it's a very substantial sum of money. Let's say, let me give you an example. 100 million, if you put in FD for a year at 3% interest rate, is 3 million, right? So yeah, cash is actually something, if I on hold to my supplier longer, the more I would generate, even if I just put in the bank, let alone if I use the money to roll and run business even further. Okay, so there are times that when you are a smaller businesses, then you might have difficulty in negotiating the term. Maybe you have to give longer term to win the business. But for international companies, normally perhaps they will have a longer payment term, depending on the company. But normally, when you run a business, it's very common to see when your businesses increases, your receivable also would increase. Then when your receivable increases, what happens to your cash? That means that my cash is now my receivable. Okay, that means that the person in Makan haven't paid me. Effectively, he still holds on to the cash until he pay me. Then it would be my cash from my operating activities, right? So for EMS industry, because it's a tech industry, so a lot of investment into new equipment, right? For example, the client want a newer model, so maybe my old machine couldn't support this. Then I would need a newer equipment every year. So the client changes product every year. So my capital expenditure, acquisition of PPE, property, plant, equipment, I have to do it every year as well. Sorry. So there is cash outflow from the company. You also have to observe that the operating cash flow the company generated, is it sufficient for them to cover the PPE? If not, probably they will get the money from the bank, which is here. Again, look into the balance sheet of the company. If it would be too much for the company to bear, right? For example, in here, there is a 311 million in terms of short-term liability, which is current liability. So you might think that, wow, there's a lot of money to pay back in a shorter period. But when running businesses, they have something called trade facilities. That means that the bank borrow the money. Specifically, it's not like our conventional car loan or housing loan. It's something revolving basis, more revolving basis. Let's say the bank borrow you the sum for 90 days, and 90 days when you get the money from your clients, then you pay back to the bank. So it's something like an advance that you get from the bank, but of course it's normally supported by the invoices and other supporting document, right? So you will see increase in loan availability. So how do you differentiate? In annual report, you can actually check it out, and you can see how what is the breakdown of the loan or borrowing of the company, right? And again, this is an example where the company combine the numbers and also the notes for quarter report together. So you will normally have here review of performances. They'll break it down to you what happens to each and different segment. Malaysia, what happened? Singapore, what happened? Indonesia, what happened? And if you are hardworking enough, you can always look back to the previous quarter report and check on their prospect. Look into what the management said in the past few quarters. Or are they very positive and then they are not delivering? Or are they prudent and they outperform and over deliver? Right? So you can get a rough idea of the whether when the company makes a lot of bold claims, whether it can be, I wouldn't say trusted, but how much should you weight those words, right, in the future, right? For the prospect parts. Some company like construction companies like TSC just now, maybe they will disclose the order book that they have. Maybe some other companies, they would just have a more general, they're saying that the economy is a bit challenging. Then they also hint you saying that consumer spending is slowing down. So you have to link it back. So for VS client, let's say if they are consumer electronic products, if you have observed, the consumer electronic companies generally they don't perform too well for their sales, like personal computer. A lot of people they already bought in the COVID period, 2021, 2022, they're not going to buy until 3 years later, normally, right? So for consumer product, it's the same as well. If I buy a, let's say, hairdryer 2 years ago, it's very likely for me to go buy another high value hairdryer for now, right? This is just an example, right, of the prospects. So on very basic level, I think these are the things that you should, three pillars that you should start looking into for the quarter report. Number one is the financial position, which is fancy term for balance sheet. It states how much asset, liability that you have, and also your profit and loss statement that see the company whether, hey, are you making money or are you making losses? What happened to you? Then the lifeline or the blood for every company, which is the cash flow, right? Cash flow is like blood for any company, like human. We couldn't survive without blood running through our company, supplying oxygen continuously. That is the same for companies as well. There's a certain limit that how much you can continuously borrow from bank. If you do not generate money or cash, you cannot pay back to the bank. Eventually, you go bankrupt. So cash flow is very, 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 very important, right? So we have a bit of time left, maybe 12 minutes. Maybe I'll pass to Shane for the Q&A session.
Thank you so much, Max, for the very enlightening session, which is also very practical because with two case studies that you immediately dissect the financial statements for us. So if you have any questions to ask our speaker today, please write them at the Q&A box here. Don't write them at the chat box. Write them at the Q&A box. All right. Okay, the first question I see on my screen is that now, see, sometimes the company do share buyback, right? So if company keep buying back shares, and if they don't terminate the share, but just put it in treasury share, will the share base reduce? Okay, so that's a question by Theo.
Yep. If I am correct, they don't terminate the share base still decreases whenever they put into treasury shares, unless they sell it back to market. When they decided to terminate, that is another write-off case. But the moment, okay, imagine in US cases, they buy back shares, they put it in treasury, but they don't normally terminate it immediately. So whenever they buy back, the float in the market reduces. So the share base would also reduce. That's if I remember it correctly. You don't have to really terminate to reduce the share base.
So the moment they do share buyback, it should be terminated, right? I mean, it should be reduces. Maybe they have not terminated yet, but the outstanding share has already reduced, lah.
Yes,
Right.
from what I remember, that is the case. So when you have a lower share base, that means that you would have a lower supply to a certain extent, so that the share price probably could go up easier, right?
But what if they don't terminate it and one day they want to distribute this treasury share, as a form of
It's,
dividend? Will the share
so
base expand again?
so imagine if I have five children, right? If I pay out, let's say if I hand out five balls to my children, one, 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 so five balls, right? So I take one back now, okay, then they would be left with four. And then when someday I decided that, okay, each of you should get one ball on your own, so I redistribute back the ball, so the share base will re-increase back at that moment when they decided, let's say, treasury shares as a form of dividend in specie. Yes, that happens as well.
All right. Thank you so much for the clarification, Max. So the next question I see from Tan is that in reference to this company called Tongguan, all right? So it's a plastic player. So in the recent quarterly report, there's an impairment in receivables and also remeasurement loss on adoption on functional currency. A bit more complex. So the question here is, can you explain on this item, functional currency? I'm not sure
To be
if you
very
are aware.
to be very fair with you, I'm also interested in what this actually means. So, Tan, can you drop me a message on my social media page if you want to invest? I'll go look into the Tongguan report later on, to find out what is actually this. I don't really deal with this term so far.
Yeah, very technical because I also
Mm,
don't see it so often. Okay,
yeah,
remeasurement loss on adoption of functional currency. Right. So thanks Tan for this technical question. Our speaker will get back to you via your PM on the social media. Right. So the next question is, when it comes to cash flow statement, which figure is the most important to you, Max? Is it the operating profit before working capital change, or is the net cash flow?
definitely after that. When you before the working capital changes, that means that before adjustment to inventory, trade receivable, and trade payables. So you have to adjust after these terms to actually get the net operating cash flow. Or yeah, this question is to operating. Yeah, definitely, it's very important to look at the net figure. Uh, if you are asking on this context.
All right. So the next question is by Amanda. So how do the fluctuations in share price affect the company and in turn investors? So does the company profit from increases in the share price? I mean, does the company earn any income from increases in the share price?
Normally, no, but number one, it will benefit the shareholders, especially major shareholder. But there's also an underlying benefit. So let me give you an example. The company has 1 million shares, 100 million shares, priced at 1 ringgit. So the total market cap of the company is 100 million. Imagine that when the share price go to 2 ringgit, then with the same number of share base, 100 million, the market cap of the company will become 200 million. So imagine this: the company needs money for their capital expenditure plan to raise fund. Now, the company decided to issue a private placement, which is a quite common way for companies to raise fund from the market. That means that I directly I print more shares of my company. Initially, I have 100 million shares. Now I print another 10 million shares. Yes, it will dilute the existing shareholders, right? But at the same time, I could raise money directly back into the company. So imagine at 1 ringgit per share, if I dilute 10%, I can raise 10 million. At 2 ringgit, when I dilute 10%, I can get 20 million. So you see the substantial change in terms of the fund raise when the share price increases. So yes, it will benefit the company. And another way of utilizing share price is when you acquire companies. So a lot of M&A going on in 2023, probably in 2024 as well. Listed companies, they would do a share swap. That means that you're running a private business. I like your business, but I'm gonna buy your business, but I'm not gonna pay you cash. I'm gonna pay you with company new shares. So I issue new shares, and we will exchange the shares in return. So there is also a value tied to the company that you are buying, right? Let's say 20 million. Again, back to the case. If your share price is at 1 ringgit for 20 million, you need to issue 20 million new shares to pay off the new company you are buying. But at 2 ringgit, you only need to dilute 10 million shares. So it's very useful in terms of fundraising and also when it comes to acquisition using their shares when the share price increases.
All right, thanks, Tan. Thanks, Max Tan, for addressing the question from Amanda. Now, the next question is by Moas Haikal. So, let's say this company has a stable cash flow for the past year. It has strong predictability. So, what method would you use to forecast the cash flows for the upcoming years?
Okay, on the basis the company has stable cash flow, let's say for the 5 years. So next question I'm going to ask myself is what the company is actually doing. Will there be any significant change for the next 5 years? So let's say if you go deeper into the numbers, right? You would, let's say it's a manufacturing company that they are operating on one shift meaning 8 hours, occasional OT, and they have 2 lines of production. Then you are able to reverse engineer and calculate how much revenue they could generate per year, okay, to predict the cash flow, presuming the cash flow is relatively stable. So you understand how much capacity, how much output they can do per year. Then you look into the comments or prospect given by the company. Let's say, for example, the company is going to install a third line for given the same number of hours working, 8 hours, one shift plus OT. Then the line is also expected to produce the same amount as the 2 line that you have. So that means there will be a 50% capacity increase for the company. Assuming that the company takes 2 years to fully utilize the line to install first year and second year to fully utilize, so you can roughly predict the revenue increase and also the profit increase for the company. It involves a bit of financial modeling, but if you want to do it, you could look into the capacity and look into any potential factors that could change the revenue generation of the company, presuming the cash flow is stable. If the company cash flow is not stable, then what do? Observe their operating cash flow every month. Every quarter. Whenever there's a quarterly report came out, observe, see whether there's any significant negative numbers over there. I could say that normally, even the company is like super good. Eventually they would have probably one or two quarters that they would have a negative cash outflow because their client timing issue, they pay them in the next month. But this month, my quarter has already closed. So it will reflect it in my next quarter. So that's one way that I would sort of predict the cash flow of the company. It's closely tied back to the forecast of their financials actually.
Thank you so much, Max. The next question is on valuation because we know that valuation is a very subjective uh, metrics, right? Some people will value it high, some people will value it low, despite giving the same set of financial statements. So the question here is, what are the key factors to determine whether a company is overvalued, undervalued, and what are the other factors that we should consider in doing valuation?
Okay, this is a $1 million question, and I wish I have a straightforward answer to you, but unfortunately, no. That is because, okay, let's go into the something that we can calculate. What are the key factors to determine a company overvalue or undervalue? That's the valuation of the company. Let's say there is absolute valuation and also comparative valuation, in my understanding. Absolute valuation is standalone valuation. Let's say the company value at 15 times PE ratio. Then the company is at 15, then it's depending on how you value a company. When you use comparative valuation, there's two ways that you can compare. Number one, compare with the peers of the company. Let's say for a construction company, the peers are trading at 10 times, 9 times, but your company is trading at 15 times. Is it reasonable? Is it overvalued? Or your PE is temporarily high because your order book is huge. That means that the PE will go lower in the subsequent quarter, or there's something special, particularly about your company, right? So a lot of moving parts to value a company, but generally speaking, there are two ways to um, uh, measure the valuation of the company. One is absolute, the another one is the comparative. Another comparative way is to measure with the historical PE of the company. Let's say the company has been trading at 10 times PE historically, suddenly it's going to 15, right? Is it overstretched, or is it because the growth prospect of the company is fantastic, right? So you need to measure that as well. Then we go into the more abstract or more, as my slide has said, valuation is an art, is because you might think, or me, I might think that this company worth 10 PE, but the market says no. I think the company should worth 8 PE. So one people, unless you are super wealthy, normally you couldn't go against the market. So the general market, whether I would say whether the market is hot now or whether the market is quite bad now, it will also affect the valuation at the moment, right? That one is external factor, whether the market agrees with your valuation or they disagrees with your valuation. But I myself, I only use fundamental analysis, so I will look into the absolute valuation of the company, then compare with peers. And for external factor, I would look at tidbit on what is the macro going on. Is it very bad now? Should I wait for slightly better timing to purchase the share? Is it crashing now? Things like that, macro factors to decide the valuation of that company, whether it's cheap or not. But ultimately, I will compare with peers and compare with historical PE as well.
All right, so that shall conclude our Q&A session. Thank you so much for all the questions. Unfortunately, we don't have enough time to address all your questions. So, well, but don't worry, we have Max coming back to do another session for us soon in the future, right? So we will catch Max again in our Bursa webinar series. So let me just take over the control to share my screen for a little bit. All right.